Hello my dear student, how are you all? Everyone fine? I am also doing great and I hope everyone is doing great with all your preparation for the upcoming exam. With this video I just want to inform you that I have prepared one PDF in which I have added all the newly added questions which I have incorporated in my 11th edition of question bank. The last edition was 10th edition in which all the questions up to RTP of November 2023 was added. After that, some new question came in November 2023 exam. Some new question came in RTP and MTP, both series 1 and series 2 of May 2024 exam. All these newly added questions have been incorporated in one single PDF which you can download by joining my Telegram channel. The link of my Telegram channel has been given in the description of this video. Join that channel, download a PDF and go through all the newly added questions. This will save your time. What I will do from your point of view, that I will record all the newly added questions for which explanation is required one by one. Today I will discuss one of the questions, but before I start discussion, don't forget to subscribe this channel if you are new to this channel, and don't forget to like the video because your one like will bring a smile on my face. Can we start discussion of one of the question? Yes sir. Now come to the question. The question is from MTP May 2024 series 2. The question related to India's 37 chapter, that is provision, contingent liability and contingent asset. Now this is related to onerous contract. Let's read the question. An entity has a contract to purchase 1 million unit of gas at 23 paise per unit, giving a contract price of rupees 2,30,000. So they have done one contract to purchase 1 million unit at 23 paise. So of course it is an executive contract. Yes sir. The current market price for the similar contract is 16 paise per unit, giving a price of 1,60,000. Now the same gas can be purchased at 16 paise per unit. Correct. So of course the contract might become onerous. Let's see. All of the gas purchased by the entity is used to generate electricity using a dedicated asset. So the gas is used to generate electricity by using some property, plant and equipment. Determine in the following situation whether the contract is onerous and provision is to be made when. Point number A. So what is the case number 1? The electricity is sold at a profit. The electricity is sold to a wide range of customers. Now because the gas has been purchased at 23 paise per unit by payment of 2,30,000. But the electricity which has been generated by using that gas can be sold at a profit. So can you say then it is not an onerous contract, because onerous contract is a contract in which the unavoidable cost of meeting that contract will exceed economic benefit expected from such contract. So of course when you can sell the electricity at a profit, so there is no burden for that and it is not an onerous contract, and therefore India's 37 will not be applicable, means there is no provision to be created. There is no provision to be created. Point number B. The electricity is sold at a loss and the entity makes an overall operating loss. The electricity is sold to a wide range of customers. Now from this case it is understood that it become an onerous contract because the electricity which is generated from that gas is expected to be sold at a loss. So can you say the expected cost of meeting that obligation is more than the expected benefit from that contract? So of course this is an onerous contract. Now as per India's 37, first you need to recognize impairment loss on the asset which is dedicated for that contract, and the balance, whatever amount is left, for that you will create provision under India's 37. So first you need to apply India's 36, calculate impairment loss on the asset which is dedicated in this contract, then whatever balance amount of loss is there, that will be created as a provision under this as per this India's 37, means as per this chapter India's 37. Chalega? Yes sir. Point number C. The entity sells the gas under a contract which it no longer need to a third party for 18 paise per unit. The entity determined that it would have to pay 55,000 to exit the purchase contract. Now point number C, what they want to say, that they do not want to produce now electricity, means they do not want to purchase that gas. Now if they do not want to use this gas for generation of electricity, means they will sell this gas once purchased. and they can sell this gas at 18 paise per unit. 18 paise per unit means there is a loss of what, 5 paise per unit. Means can I say in this case, of course the contract is onerous. Now Ind AS 37 says that whenever this is the case, the amount of provision will be equal to the lower of the unavoidable cost of meeting that obligation or penalty which is payable to exit from the contract. So what is the unavoidable loss? Unavoidable loss is 5 into how many million? 1 million means 50,000 or 55,000, whichever lower. Therefore, in point number C, we should create a provision of 50,000. Let's see what the answer has been given. Point number 1, the gas will be used to generate electricity which will be sold at a profit. The economic benefit include the benefit to the entity by using the gas in the business, and because the electricity is sold at a profit, the contract is not onerous. Chalega. Point number 2, the electricity is sold to a wide range of customers. The entity first consider whether the asset used to generate electricity are impaired as per Ind AS 36. To the extent there is still a loss after the asset have been written down, a provision for onerous contracts will be recorded. This also we have discussed now. Point number 3, the only economic benefit from the purchase contract costing rupees 2,30,000 are the proceeds from the sale contract which are 1,80,000. So there is a loss of how much? A provision should be made for the onerous element of 50,000. Correct? Being the loss of cost of fulfilling the contract and the penalty cost of the cancellation, that is 55,000. So 50,000 or 55,000, whichever is lower, we should create a provision in that regard, whichever is lower. I hope the question is new question, but the concept was not new. Correct now. So whenever new question come, a discussion is required so that in exam similar question came, you are not confused with that particular question. I hope you find this video useful. Correct. Share this video with your friend. Of course, they will also get benefit from this video. In the next video, we'll come with one more new question. Till then, bye bye. Enjoy your studies. All the best for your preparation. Bye bye. All the best.